Oh, right. Walmart is the largest company in the world when measured by revenue or when measured by total employees. And so it's understandable that a lot of investors would be interested in Walmart stock. In this video, I'm going to do a discounted cash flow valuation of Walmart and answer what I think is a fair price to pay for Walmart stock, and subsequently answer whether or not I think Walmart stock is undervalued at current prices. So let's take a look at this massive company.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so three of the numbers I need to make this calculation are the market cap at $751 billion, the company's cash balance at $10 billion, and the total long-term debt at $40.47 billion. I also need the total number of shares outstanding at 8.082 billion, and I need the beta for Walmart stock, which according to Yahoo Finance, Walmart's beta is 0.52. This is among the lowest of any of the companies that I've done a discounted cash flow analysis for. And you can understand why that's the case. A beta of 1 means that a business is about as risky as any business in the S&P 500 index. Walmart at a beta of 0.5 suggests that it's less risky than most of those companies in the S&P 500 index. And by risky, what you take that to mean is, first of all, in comparison to the macroeconomy, when the economy is in boom times, Walmart does reasonably well. People have more money. People spend their money at Walmart. When the economy is crashing, Walmart does reasonably well also. Why? Well, because the people that are wealthier, that usually might be shopping at Target or Costco, will go to Walmart for the lower prices. So whether the economy is booming or declining, Walmart does reasonably well because of its strategy, its low-cost strategy. Also, the strategy that it employs, it's the most difficult strategy. The low-cost strategy, to execute on that strategy, is the most difficult business strategy that you can undertake. And those of you that are in business, those of you that are entrepreneurs that are watching this, can probably understand why that's the case. When you're operating a business, trying to be the lowest cost provider among all of your competitors, imagine trying to do that, to always offer the lowest prices. Imagine all of the things you need to do in order to be able to provide your customers with the lowest prices across all categories. Very difficult to do, very challenging to do. Walmart has managed that excellently over decades, not just years. I also need the Wall Street analysts that are following Walmart stock. I need to know what their free cash flow estimates are for Walmart over the next 5 years. And according to those analysts that are following Walmart, they think the company will deliver 2024 is already complete for Walmart. Their fiscal year 2024 completed on January 31st. They delivered $15 billion in free cash flow. Analysts expect the company to deliver $13.8 billion in 2025, $15.4 billion in 2026, $18.6 billion in 2027, $27 billion in 2028, and $29 billion in 2029. So the analysts on Wall Street, they expect Walmart's free cash flow to be middling over these next 2 years and then increasing from 2027 to 2029 robustly. All right, now that we have all of the inputs, we can jump to the valuation model for Walmart stock, starting with this point here, which I highlighted, the $15 billion in 2024 for Walmart. That's already completed, and these are forecasts from 2025 all the way to 2035. Now, according to the Wall Street analyst estimates, they have the company's free cash flows growing at a robust rate over these next 5 years. And I have the company's free cash flow growing at 6.5% over the years between 2030 and 2034. From 2035 onward, I have the company growing at the longer term cash flow of 5%. This is the nominal growth rate of the economies that Walmart operates in. I expect the company to grow at roughly equivalent rates of the economies it operates in, which is not only the United States. Walmart has operations in several countries around the world, over 10,000 store locations, over 10,000 brick and mortar locations worldwide. So when we discount all of those future free cash flows, right? And the reason we need to discount them is because money in the future is worth less than money today. So we need to discount those future cash flows back to today. And I get a value of all of the free cash flow that Walmart is expected to generate between now and infinity at $956 billion. That's the present value of the cash flows. Now, I'm using a weighted average cost of capital of just 7.6% for Walmart because the beta is so low. When the beta is low, that means the company is less risky, and you can apply a lower discount rate for a company with a lower beta. Now, you can argue that I shouldn't use such a low beta, that I should use a higher beta. Well, thankfully for you, I've done a scenario, 2 different scenarios, including incorporating a higher beta, and I'll share with you those calculations as well in this video. So when using this beta, the beta according to Yahoo Finance with no adjustments, I get the value of operations at $956 billion. Add the company's cash, subtract the debt, and you get a value of equity at $925 billion. If you divide that by the number of shares outstanding at 8.082 billion, you get a price per share of $114 for Walmart stock. That's compared to the current price of $93.55. So if you use these inputs, it would suggest that Walmart stock is undervalued. However, if you do feel that the beta is too low and the beta should be adjusted upward, here's the calculation for you. When I adjusted the beta upward to 0.75 from 0.52, that gave me an intrinsic value per share of $75. When I adjusted the beta upwards to 1.25, that gave me a beta of $53.64. So if you think the beta should be higher than 0.52, and if you think it should be at 0.75 or above, that would suggest that Walmart stock is overvalued, and vice versa. If you think the beta is okay, using historical numbers, then that's suggesting the company is undervalued. My argument is that Walmart beta should not be adjusted. And here's my case for that. When I make an adjustment to a company's beta, it's usually because I feel something is going to be different in the future than it has been in the past. Usually when I'm evaluating a smaller company that's expected to grow rapidly over the next 5 years or so, I expect that company, if it has a higher beta, that the beta will decline as the company grows larger, and it'll approach the beta of the average stock in the market. However, I don't see things changing all that much for Walmart. I don't see things improving by all that much, and I don't see things declining for all that much for Walmart. I just see steady growth for this company in the low to mid single digits in terms of revenue. I would say closer to low single digits. If they're lucky, they'll get mid single digits. And so that's where I expect this company to grow, whether the economy is booming or busting. I expect them to do reasonably well about where they are today. So for all those reasons, I feel the beta should be where it is, but I can understand if you feel differently. That's why I included those other scenarios with the different betas. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.